Every investor knows the feeling of losing sleep at night during rough patches in the market, but have you ever actually quantified the risk in your portfolio? I'm Jack Otter, editor of Barron's.com. I'm here with Mary Deatherage, a private wealth advisor at Morgan Stanley. So you make a point of going to your clients and telling them, here's where the risk is and here's where we can go to maybe mitigate it. But how do you explain that and what do you tell them?
I think everybody considers risk to be a bad word, as if let's never take any risk. You're never going to make any money unless you take risk. But let's quantify it. And it's really important to know how much you can handle. And then we look at the portfolio, because the portfolio often doesn't reflect the risk you really want to take. And the way we do that, I think risk is the S&P 500. So we look at a 5-year S&P 500 volatility level and compare every single piece of your portfolio to that. And what's really surprising is some of these securities have twice as much volatility as the S&P 500.
So that means an individual stock is going up and going down twice as much as the broader market.
Very surprising. And then you look at those holdings, you think, wait, is this holding worth spending a lot of my risk budget for? And if it's not, maybe you peel that back.
So how do you peel back risk?
Well, the idea is that, again, risk isn't bad. If you diversify, that's where asset allocation comes in. For example, emerging markets are always going to have more risk, but they may not have the same volatility as the S&P 500 in different environments. Exactly, and that's the whole point, is if you have got a core positioning and you know the risk you're taking there, satellite around with other securities that could pull the volatility down but still allow you to make return.
And you also look into multiple asset classes, presumably some ZIG while the others ZAG. What are some asset classes you're using?
Well, for example, real estate. So if real estate has been beaten up, is now starting to recover, not just in the US, but globally, and oftentimes has a good yield, that's an asset we want to look at. We do look at emerging markets kind of cyclically, and the cycle seems in a good place today. Some of the international markets.
Which might be counterintuitive, by the way, because of course it's gone down a lot, so people see it as scary and risky, but in fact, there may be less risk baked in than, say, an expensive S&P 500.
Exactly. I mean, some emerging market debt seems like oxymoronic to think that you'd buy it, but in fact, it can make a lot of sense in an environment where bonds have a fair amount of risk. You know, people think, well, bonds are so boring, and I'll just buy treasuries. Well, the interest rate risk of treasuries is higher than many junk bonds. So there's a lot of different ways to blend the volatility and maintain growth potential.
Now, one thing you said you do is you play a little bit of the shrink, and you sit your client down and you ask about different scenarios. Can you explain that?
Sure. I bring it up, and men investors, women investors, everybody wants to talk about it because it's kind of a mystery. It doesn't have to be. So I'll say, you know what? We started the year with $1 million, and it's been a tough market. And at the end of the year, it's still $1 million. How do you feel? And most people say, I can handle that. That's fine for me. And I'll say, okay, it's been a really bad year. We started with $1 million, and now it's 900,000. And then people, even if they're on the phone, I can kind of tell the body language, and they'll say, well, I could handle that. I think I could handle that. I'd understand. I say, okay, we've had a really bad year, and your $1 million went to 750. And then if they're not in front of me, I can feel them wiggling in their chair. If they are in front of me, many people say, I couldn't do that. All right, that's good. That allows me to help design the portfolio that fits you, not everybody else in the world. And I'll remind them at the same time, okay, if we don't want 25% downside, we're not going to get 25% upside.
Wait a second, I want 25% upside.
Yeah, it's the tortoise and the hare, okay? So the point is that you're still going to finish the race as the tortoise. You may not have as much fun as the hare, but investing is not supposed to necessarily be fun either. It's supposed to be building for your future.
Well, as we enter the 8th year of a bull market in U.S. equities, this is probably a good thing for people to keep in mind.
I think so.
Thanks very much, Mary.
Thank you.